Welcome back to our intermediate financial accounting class. We've been talking about long-term debt over these last few segments, specifically focusing on bonds, which are perhaps some of the best examples of long-term debt. Now, the concepts and ideas and the methods that we're talking about, while we've been showing them with bonds, keep in mind that they work for any kind of long-term debt. The amortization of interest, making sure that when we retire the debt, everything associated with that debt goes off of our books, the way we talk about it at 97, at 102, etc. All of that is applicable to all of our long-term debt. Now, in addition to just issuing bonds and recording payments, we also have been talking about early retirement, extinguishing our bonds. And that leads us quite naturally into the next concept or topic, and that is converting bonds and how we record those conversions. So let's go ahead and talk about those concepts. A lot of times, well, not a lot of times, companies will sometimes add a conversion clause into the contract of a bond or other debt. The idea is that we want to make our bonds more appealing to investors by allowing them to convert these bonds into common shares so they can switch from being a bondholder to a common stockholder. Now, there's a lot of reasons why we might choose to do this. We do it because it makes the bonds more appealing. We do it because it gives us an option to maybe get rid of some debt and turn into equity if there's a debt covenant that we're in danger of breaking. Companies will just say, hey, you can convert. And to help you decide to do it now, we'll offer an extra $100 a share to get you to do it right this very second. So that's a possibility. The other thing is investors are willing to pay a premium for this option to have the flexibility to switch from debt to equity. And so they drop their expected interest rate because some of the risk goes away. I can shift from debt to equity, so I'm safer there. And as their expected return drops, then we get less of a discount or more of a premium on these bonds. So that's another reason why companies will do this. To kind of protect themselves and their current investors, one of the other things they'll do is they'll limit the time period. So we may issue a 10-year bond and it's convertible within the first 3 years or 4 years or 2 years. Because what we don't want is people saying, I've got a convertible bond, I'm going to get all the interest payments for 9.5 years and then I'll convert in the last 6 months. So that's one of the clauses that we use to keep people from abusing the system. Now, the good news from an accounting perspective is we record these bonds the same way as every other bond. We don't have to do anything special to record them. The only time we do something special is when the conversion happens, and we're going to use a special method called the book value method to account for the change from debt to equity. And the basic idea of this book value method is that I take the value in my liability account and I move it directly into my equity account. So I'm not looking at stock price, I'm not looking at the market price of the bond, I'm ignoring all of that. I'm just going from the book value of the bond to the book value of the equity. Now, we haven't done this since the beginning of the semester, but it really helps with this concept. Remember, we did assets equals liabilities plus equity, and we showed how they change. Well, if we do a bond retirement, assets drop because I'm paying off the bond, and liabilities drop because those liabilities are gone. But I stay in balance because I'm giving up the assets to get rid of the bond. Now what we're talking about is a bond conversion, and using the net method, what I do is I take off the full bond value and I put it into equity. So nothing has to happen with assets at all, no gain or loss happens, nothing. I'm just transferring it from debt to equity straight across. Pretty cool, huh? I should mention before we go on, this method is also used for any other convertible securities. And there are other kinds. There's other kinds of convertible debt, preferred stock is sometimes convertible, and we use that same book value method no matter what. Let's take a look at an example of this. This is Simon Corporation. They issued a $10 million 5-year 15% bond at the beginning of year 7. The bond carries a 3-for-1 conversion option for Simon's $2 par value stock. The conversion period lasts only until the end of year 8, so it's a 2-year limit on conversion. The market rate on the bond is 10%. Bond makes semi-annual payments. And we're going to assume, just to keep things simple for our example, that Simon uses the straight line method. We want to make the journal entry for the voluntary conversion if everybody decides to convert at the very end of the conversion period. Now, the first thing we need to do in order to solve this problem is figure out how this bond was initially recorded. And to do that, we need a present value. We weren't told it issued at 102 or 97 or 98. We have to do the calculation the old-fashioned way. You should be good at that. By now we've had several examples and several practice opportunities, so I'm going to let you go ahead and do that calculation. Did you start out deciding that this was a premium bond? Remember, that's always our first step. We don't want to accidentally mess up interest rates and not have a way to check and make sure that we did it right. So hopefully you did that step first. Then here's the rest of the numbers and the values, and you should have ended up with a bond value of $11,930,398. Definitely a premium, and we are good to go. So again, if we're going to do this conversion, we're going to have to be able to get rid of everything on our books associated with this bond, which means we have to get rid of both the bond payable and the premium. And in order to do that, I have to know what the premium looks like. So let's go ahead and do the journal entry for the issuance of this bond. More journal entries. Isn't this great? So let's see. The cash we just calculated was $11,930,398. The bond payable is $10 million, and the premium is the difference. Issued a $10 million semi-annual (15% 5-year) bond at 10%. For straight line, we take the premium divided by n. So 1,930,398 divided by our n, and that was 10. So if we round to the nearest dollar, we get 193.40 as our amortization amount. So just for fun, let's do the interest payments. Let's see, we'd get rid of some premium. It's got to be a debit because we have a credit up here. Cash, we calculated as $750,000. Interest expense in the straight line method is our plug figure. So $556,960, and this is our interest payments. Now we've done this 4 times, which means overall we've amortized away. If I take the $193,040 4 times, it's $772,160. How did I get the 4? Well, we issued at the beginning of year 7, so there would have been 2 payments in year 7, and they're going to convert their bonds at the end of year 8, so that's 2 more interest payments before they convert. So that's a total of 4 payments, and I'm making the assumption that they wouldn't convert right before that last interest payment. They'd wait, get their interest, and then convert. And I think that's probably a pretty reasonable assumption for most companies. So let's see, let's get our premium T account ready to go so we know what we need to get rid of. So we start with $1,930,398. We've amortized away in 4 separate payments the $772,160. So I have left on my books $1,158,238. So let's take a look at that journal entry. We've got to get rid of the bonds payable, $10 million. I've got to get rid of the premium, which we just calculated was $1,158,238. Now I'm not giving them cash this time. This time we're giving them shares of stock. So let's see. Each bond gets 3 shares of stock for every 1 bond, and they've got a $2 par. And we haven't talked about par value yet, but it's basically our initial guess at what we thought our stock was worth. We'll talk about it in more detail when we talk about equity. So we're going to put that in a separate account. Anything extra will go into additional paid-in capital. And again, that'll make a lot more sense once we've talked about equity, and hopefully here in a second once we've done it. So our first question is, well, how many bonds are there? Surely they're not just getting 3 shares of stock for $10 million. And the answer is no. We talk about a bond as if it were one big huge bond. So this is a $5 million bond, it's a $3 million bond, it's a $10 million bond. What it really is a bunch of small bonds, and we add it up to get one big bond issue. And unless they say otherwise, bonds are always issued in $1,000 increments. So you can assume it's $1,000 for each individual piece of that big bond, unless it says otherwise. So let's see, a $10 million bond divided by $1,000 increments gives us 10,000 actual bonds that we can sell to different investors. Each of those bonds gets 3 shares of stock, so that's 30,000 shares of our common stock. And we're going to split the value. This value over here has to go into our common stock accounts. And there's 2 common stock accounts. One is par value, and into that account we can only put $2 per share, whatever that par value is. So $2 a share times 30,000 shares is $60,000, and that's going to go into our common stock account. Now anything over par goes into an account called additional paid in capital common stock. So I take my 11,158,238, that's my total debit. I subtract out the $60,000 that goes to par, and the rest goes into additional paid in capital common stock. And that's it. There's no gain, there's no loss. Remember, I'm just transferring from debt to equity. And this is conversion of $10 million bond from debt to common stock. Now we've done this with the whole bond, but just like we can do with extinguishing debt, we can convert just a small portion. You may have just a few investors decide, you know what, I don't want debt, I want equity. So you can do this entry for even just one bond. You take the amount of the premium divided by 10,000 to get one bond's worth, and that's the amount of premium you'd get rid of. And you debit bonds payable for $1,000, and then the rest of it would go into common stock and additional paid in capital. So you can do it for one bond, you can do it for all the bonds, you can do it for 20% of the bonds. You just take these total amounts times that percentage, and that would give you the amount you'd use for whatever fraction or whatever percentage is being converted, or in the extinguishing debt section, retired. Now, the last thing we want to talk about with converting debt, sometimes companies will give an incentive to try to get people to convert, right? We need this debt to convert because we're right on the border of our debt covenants, or we're out of cash to make the interest payments. Let's do something to get them to convert. And so what they'll do is they'll offer an incentive. So let's change this journal entry and this calculation, assuming that to get everybody to convert, the company had to offer a $10 bonus for each share of stock. The good news is we don't have to change anything we've done up to this point if we offer a conversion incentive. So what we do with the bonds payable and the premium account stays the same. What goes into common stock and additional paid in capital, all that stays the same. All we have to do is add the incentive. So this is $10 per share of stocks. So 30,000 shares of stock times $10 each means that we're going to pay $300,000 to these new shareholders as part of getting them to convert. So if I'm paying them $300,000, that means I've got a credit to cash. And I put that in a cleverly labeled account called bonds conversion expense. The only other thing I'd need to do would be to add to my description with a $10 incentive for each share of common stock. And incentives can be per share of stock, they can be per bond, they can be however they want to do it. Now we have talked a lot about bonds over the last few segments. We've done lots of journal entries, it's been a lot of fun, lots of great calculations. There's so much cool stuff with bonds, but it's time that we talked about something else. So in our next segment, we're going to transition into mortgages and notes. I'll see you then.